So this is how I'm looking at my portfolio for the remaining of 2026. I'm not trying to predict which stock is going to perform the best for the remaining of year. I'm looking at my portfolio in a much simpler way. I want a strong base, some room for growth, enough balance so that I'm not depending on one area of the market, and a small amount of money available for higher risk opportunities. Because nobody knows what is going to happen for the remaining of the year or the upcoming year. AI is growing very quickly. Technology companies are spending billions of dollars and building data centers and new AI product. At the same time, some stock prices have already gone up. For example, Nvidia, AMD. However, there is still some uncertainty in the market because of interest rate, inflation, the economy and geopolitics. If interest rate and inflation stays high, generally the market does not see as a positive sign. So instead of trying to predict all of this, I want to focus on the things that I can actually control. So my foundation stays very simple. The largest part of my portfolio will continue to be going for the ETF. An ETF could be S&P 500, which tracks 500 biggest companies in the US, which includes Apple, Microsoft, Amazon, Google and all. And I do not have to worry about which company is going to perform the best. My money will be directly going into 500 biggest companies. If one company doesn't perform well, it is not going to matter much to my portfolio. And I do not want my entire financial future depending on whether I pick 3 or 4 good individual companies or not. But at the same time, I want some growth and good exposure into companies which might be performing well in the upcoming year. AI, cloud computing, semiconductors and technology are still areas that I find very interesting. And one particular area that I'm very interested in is energy, because data centers and all, like for example, Microsoft, Amazon, Nvidia, they're very highly invested into companies who works with data centers, and data centers, they need a lot of energy. Because a great company does not automatically mean the stock is a great deal. So a company can have excellent products, strong sales and great future. But if the stock price already expects years of very high growth, even a small slowdown can hurt that stock. So I still want growth, but I also want to pay attention to what I'm paying for that growth. I want more balance. I also do not want my entire portfolio depending on technology and AI. So diversification matters a lot, and I want to diversify my portfolio into different sectors as well. And one good example is Berkshire Hathaway. It has businesses in insurance, energy, railroads, manufacturing, and many other areas. So that is very different from companies such as Nvidia and Microsoft. So if I'm buying Berkshire Hathaway, that gives me to exposure of different companies as well. So the idea behind diversification is very simple. If a company had a bad year, I do not want my portfolio to suffer for the same reason. I'm also interested in keeping a small amount in the international market. The US will probably remain the largest part of my portfolio, but having some investments in other countries gives me another layer of balance. So higher risk stays small. There are also some areas where I'm willing to take more risk. That could include investing a little bit in Bitcoin, smaller AI companies. In fact, I'm investing in some of these smaller AI companies, quantum computing companies, or other newer technologies. So these investments can have a lot of potential, but at the same time, they can also fall very quickly. So I treat them very differently from the main part of my portfolio. If one of them performs extremely well, that is great. But if another falls 70%, that should not hurt my portfolio really badly. So I keep a very small percentage of my portfolio into these companies. The biggest stock market investor, Warren Buffett, he always tried to have cash of around 20% of his entire portfolio. So this is different from emergency saving. I do not want too much money sitting in cash for years because I want most of my money to be invested. But having some cash gives me flexibility, because if the market drops and strong companies become available at better prices, I can invest more. For example, back in 2022, Meta was trading around $90. So that was a really good deal. And nobody knows when the major market crash will happen. So I'll keep investing regularly while keeping some money available for opportunities like that. So moving forward, I'm not trying to build my portfolio differently. I'm just trying to improve what I already have, keeping a broad market foundation, owning some strong companies, and trying to invest a small percentage into smaller companies. So when I look at an individual company, I also want to keep research very simple. I want to see growing sales, real profit, healthy cash flow, manageable debt, and businesses that customers continue using. And then I want to make sure I'm not paying unreasonable price for that stock. So I cannot control what the market does in the next few months or next few years, but I can control what I own, how much risk I can take, and whether I continue investing consistently or not.